Hello, my name is Marc DeCastro. I'm a research manager for financial insights, consumer banking, and credit practice. I'd like to spend some time to talk about P2P lending, whether it's profit or just for folly. So what's the latest on peer-to-peer lending? A quick definition of peer-to-peer, often just called P2P, can be thought of as utilizing today's technology to find investors to borrowers without the need for traditional financial institutions. This does not mean that banks are not used for the settlement of funds, but rather the movement and interest earned are charged and done through non-traditional providers. At this point, while still early in the game, it appears that there are a few that I would call the winners. Lending Club has gotten the SEC approval to operate in the United States. Their website shows they have made over $30 million in loans since inception. Now, they reject loans at a rate of 88% during the month of February 2009. They're basically unwilling to fund risky loans. Since inception, they've actually declined over 30,000 loans while making only 3,578. Of those, 2.47% are late, defined as 30 to 120 days late, while an additional 4% are in default, 120 days late, including charge-offs. So far, only 72 loans, or 1.74% of all loans, have been charged off at Lending Club. Investors are able to direct where their investment dollars go, and Lending Club gets a piece of each transaction. A different model is P2P Direct. It's kind of a mutual fund or P2P lending site. It's really hard to tell. Basically, there's two funds people can enter into. One is less risky and lends only to those with a credit score of 720 or higher, while the other is more risky, provides a higher return, but lends to those with credit scores that can be as low as 660. Investors are not able to choose specific places or individuals for their investment dollars. One then could question, is this really P2P or not? P2P Direct also has an annual expense ratio similar to mutual funds. At last check, they were well over 3%. Virgin Money is a little different. They're basically trying to take the sting out of borrowing money from friends and family. It's a three-step process for them. First, you find someone you know willing to lend you money. Then you go to their website, you set up all the procedures, and finally you determine the interest rate and payment plan, and then you finalize the deal. So of course there's some that haven't fared so well. Zopa, Prosper, and Lonio no longer operate within the United States. Concern over how they will comply with SEC rules and regulations around soliciting investments. Zopa now simply takes visitors to an affiliated credit union site. Prosper promises that they are still in a quiet period and awaiting regulatory approval. This break in continuity could hurt their chances of capturing this market. Lonio has pretty much entered the exact same message regarding the quiet period. How about those that want to provide loans for the right reasons? To Surfa Mary in the Sudan to raise $575 to expand her business selling tomatoes to help support her 3 children and send them to school. Getting funds directly into the hands of individuals as opposed to providing them to large charitable organizations has appeal, as you can actually see and determine where your dollars go. Sites like Kiva help support this, and it's social networking that really has tremendous upside. This is a quick personal example. We've all seen the value of our investments decline over the recent year. One report shows that when adjusted for inflation, the market in 2009 is at the same level it was in 1966, 43 years ago. Anyway, my example, if I had invested $52 in the Dow on January the 1st of this year, on March 9th the value would have dropped to $39.52, a 26% decline. That same $52 invested in a P2P site has recently grown to $52.66, and while 66 cents won't even buy me anything off the value menu, it would be an annualized 12.68% return. Right now, any positive returns would be welcome, particularly double-digit returns. So what should we look for? Well, it's still early in the game, but banks should really monitor P2P lending. Web 2.0 technology has helped get P2P off the ground and onto the screen. Don't underestimate the feel-good angle, both from lenders and borrowers. Partnership with a successful solution may be better than building from scratch. And watch for the default growth in this space. It could snowball and skew returns. Thanks for listening. Let me know what you think. Post your comments in our community.